Chris Hallows with Benchmark Mortgage here, doing a 2023 mid-year update. And gosh, there's so many emotions and thoughts going into the market right now. Is we're seeing, just like you can see on my slide here, fear, confusion. Some things are just weird. It doesn't make sense why certain things are moving fast, and there's multiple offers, and other things are kind of sitting. And so ultimately, we want to get away from emotions and speculations and mainstream media skewed perspectives to facts, and give you that facts and data on why housing market interest rates are in certain situations, and with those facts and given historic trending and perspective, what could possibly be around the corner for us. So we're going to move pretty quick here. We're going to get a little technical just so you can try and understand where that perspective is coming from. Feel free to pause certain slides, really take some time to digest it. We're going to dive right in, and we're going to start with interest rates and inflation. And so really, interest rates have been moving up hand in hand with inflation. We saw them come off of the highs, so the worst is behind us, going from October mid sevens or so on 30-year fixed primary residence into the sixes, and it kind of hovering around there, with the biggest thing being watching inflation. So this is the Consumer Price Index report that just came out. I'm recording this mid-June, so this just came out June 13th. And a lot of experts have been saying, wait for inflation to start really ticking down, and we should see interest rates start to tick down with it. The tricky part is the last two reports. So then April's numbers got reported on May 10th, and then May's numbers got reported on June 13th. Both saw a reduction in inflation, but they were more paced and moderate, primarily because of used cars. Used car numbers were spiked these last 2 months, which is not sustainable. Things are going to shift up there, as you can kind of pause and digest this chart through to say, okay, it's got to be in the next couple months, next maybe month 2 or 3, that we see some significant shift in inflation lower. That should really then help our interest rates. And when we talk about, well, then, what's normal? What is a normal interest rate? What's important to understand is markets don't like volatility. So when I come to this chart and we look at, okay, let's look at the 10-year Treasury yield, so a market index, and compare them to 30-year fixed interest rate. And historically speaking, I'm looking back at like over 40 years of history here. Mortgage rates are usually within 1.72% of the Treasury and follow that very closely. We are not within that right now. If we look at right now what's happening, we're 2.7 to 3.2 above the Treasury. And why is that? And simply put, the only times the spread approached or exceeded 300 basis points were during periods of high inflation or economic volatility, like those seen in the early 1980s or the great financial crisis of 2008-2009. So I'll move so you can see that's from George Truya, chief economist with Keeping Current Matters. And so that's where it's just volatility. Markets and investors just are scared of this inflation and what's going on. So rates are arbitrarily higher right now. And so we can say, okay, without market actually getting better, but if we just get to normal, right? If we can get away from this volatility, we can get a handle that inflation is really, really meaningfully chalking down. What does that look like, right? If we are at that normal spread of 1.72, rates would be in the low fives right now, right? Currently, they're in the high sixes, mid to high sixes. And then, if we go, some experts are saying, well, we might not see that normal spread right away. But even if we start to get to some stability and get that spread down without really market improvement, we're going to see into the fives. So that's where we're coming from, a basis of it. In the next few months, we should hopefully be seeing rates ticking down into the fives. Further from that, we'll have to see heading into end of the year and into 2024 what happens with a lot of dynamics of coming off of these high inflationary times. Do we head into recession? Do rates go even lower? There's lots of speculation there. We'll put a pin in it for now. And then really quickly going through national and local housing, what I want to make sure to illustrate here is it's so important to see the month-over-month changes here. And so when we look at this from January 2022 to current, sure, we did see some month-over-month slowdowns when we hit those really high interest rates, but you can see that we're already ticking up, right? The cream kind of came off of the top there with what happens to a market when you're in like 2% interest rates, but prices are already stabilizing. So a lot of folks in the fall were calling for like 20%, 30%, even some YouTubers I saw calling for like 50%, or experts, right, calling for 50%, reduction in sales prices. I haven't seen it. Haven't seen it even despite the current interest rates. And what I think is important here, that we understand that we had some unicorn years, right? We want to separate that from the pain and true loss of a pandemic, but really understand what happened in real estate and just kind of refer to 2020 through 2022, the unicorn years. And I'm going to go really fast through these to just show you, you know, home appreciation from unicorn to pre-unicorn. If you compare that, appreciation's way down. Well, yeah, but it's normal compared to pre-unicorn, right? If we look at pending listings, pretty darn normal. We look at showing traffic, it's actually higher than pre-unicorn years. Median days on market right now it's showing 43. I believe Flagstaff. These are national. Disclaimer there. We are at 47, I think, right now in Flagstaff. So we're actually homes are selling quicker than even not as fast as unicorn years, but quicker than pre-unicorn. Homes for sale on its way up slowly there. And then if we look at months inventory right now, we are just above about 3 in Flagstaff months of inventory. So not quite as skewed seller market as we had been in unicorn, and getting hopefully back to a little bit of normal there. And foreclosures, gosh, you got to understand there is a national moratorium on foreclosures, right? There was forbearances on payments. So of course we're going to see lower foreclosures, but our activity now, even though you can see, gosh, it doubled, it's well below pre-unicorn years. So nothing really to be concerned about. 17, 18, 19 were all fantastic real estate years, and we weren't seeing tons of foreclosure markets, foreclosure opportunities in those markets. So bottom line, guys, the financial benefits of homeownership, the social benefits of homeownership, the tax benefits of ownership, and really ultimately leading to where Americans believe that 34% of Americans believe that real estate is the best long-term investment, and still. So, I mean, we're going to get through some of this weirdness. I believe there's just some fantastic opportunities. And the bottom line is connecting with experts to understand each individual situation, your goals. The next coming months are going to see some awesome real estate opportunities. And we are definitely here along for the ride to help you find those, and just give us a call. All right, thanks.